Ask anyone to name the top AI stock, and almost everyone gives the same one-word answer: Nvidia, the company that makes the chips powering nearly every major AI system in the world. With a market capitalization that has, at various points, made it the single most valuable publicly traded company on Earth. Here is what most casual coverage misses. Look at Nvidia through one specific valuation lens, and the stock looks almost reasonably priced for a company growing this fast. Look at it through a different, equally legitimate lens, and the exact same stock looks expensive in a way that should genuinely concern anyone buying at current levels. Both readings are correct, sourced from the same current data, at the same moment in time. They are simply measuring different things, and almost nobody explains which one actually matters more for a specific investor's situation. This video covers the three companies that dominate any serious conversation about AI investing: Nvidia, Microsoft, and Alphabet, with the real current numbers behind each one. What each company actually does inside the AI build-out specifically, the genuine growth drivers behind each one's results, the contradictory valuation signals worth understanding before you trust any single ratio in isolation, and the specific sourced warning signs that deserve your attention regardless of how excited the broader narrative around any of these three names happens to be. If you want to keep your money mindset sharp and learn how to make your capital work for you, consider subscribing to the channel and liking this video. It truly helps the channel grow and teach people about financial education. Now, let's get right into today's breakdown. What Nvidia actually does inside the AI build-out: Nvidia designs the graphics processing units, or GPUs, that serve as the dominant computing hardware for training and running large AI models, described by independent coverage as the infrastructure layer beneath virtually every major AI model in operation today. The company is restructuring its own reporting around this reality, organizing around two market platforms: data center and edge computing. With data center itself split into hyperscale, revenue from public cloud providers and the largest consumer internet companies, and what the company calls ACIE, AI clouds, industrial and enterprise, purpose-built AI data centers across industries and countries. The current numbers, sourced directly: Nvidia's full fiscal year 2025 revenue reached $215.9 billion, up 65% year-over-year, driven mainly by AI data center demand. The company's data center compute revenue hit a record $60.4 billion in a single recent quarter, up 77% year-over-year, with data center networking revenue at a record $14.8 billion, up 199% year-over-year. The stock trades around $192.71 to $195.55, with a market capitalization of approximately $4.66 to $4.72 trillion and a 52-week range of $151.49 to $236.54. Here is the vault from the opening. The contradictory valuation picture resolved directly. Nvidia's trailing P/E ratio sits at approximately 29.48 to 31.7, and its forward P/E, based on expected future earnings, is 27. Described by one source as not that stretched, especially set against earnings expected to grow 71.1% this year, after jumping 59.5% last year. Dividing that forward P/E by the expected growth rate produces a PEG ratio of just 0.7, and a PEG ratio under 1.0 is commonly read as a signal that a company offers both growth and reasonable value at the same time. But the same source immediately flags the contradiction directly. Its PS ratio tells a different story. It's at 21.4, which indicates investors are paying a high price for the sales. Separately, one analyst specifically notes Nvidia's price-to-sales ratio remains well above its historic norm, even while its PE-based metrics look comparatively tame. Why both readings can be true at once? The PE and PEG ratios look favorable specifically because Nvidia's profit margins are currently extremely high, meaning its earnings have grown even faster than its already explosive revenue. The PS ratio strips out margin entirely and asks only how much investors are paying for each dollar of sales. And on that specific margin-independent measure, the market is pricing in an assumption that Nvidia's current extraordinary margins, not just its revenue growth, will persist indefinitely. If margins compress for any reason, increased competition, customers building their own custom chips, pricing pressure from major buyers, the PE and PEG ratios would deteriorate quickly, even if revenue kept growing, which is precisely the risk the PS ratio is already pricing in today. The genuine sourced risk specific to Nvidia. Independent analysis flags that Nvidia has underperformed in 2026, rising only 12% year-to-date compared to the VanEck Semiconductor ETF's 85% gain, citing challenges in GPU demand and pricing, with competition from Qualcomm's new AI architecture gaining attention. Separately, multiple hyperscaler customers, Google, Meta, and others, are actively partnering with Broadcom to reduce their reliance on Nvidia, a direct, sourced customer concentration and competitive risk specific to the company that holds the largest share of this AI build-out today. What Microsoft actually does inside the AI build-out, rather than building its own AI chips as a primary business, Microsoft has integrated AI directly across its existing product ecosystem. Azure Cloud Infrastructure, Microsoft 365 productivity software, GitHub developer tools, and enterprise software broadly. Monetizing AI primarily through subscription and consumption-based revenue across products it already dominates, rather than through hardware sales. Independent coverage notes that more than 65% of Fortune 500 companies already use Azure OpenAI services, a direct, sourced measure of enterprise penetration specific to Microsoft's AI offering. Why independent analysts describe Microsoft as the stable AI stock? One source frames this directly. Investors view Microsoft as relatively stable specifically because it combines strong AI growth with diversified revenue streams from cloud computing, gaming, productivity software, and enterprise technology services. A separate ranking explicitly states Microsoft is not waiting for an AI business model to appear because Azure sells AI capacity, GitHub sells developer productivity, Microsoft 365 pushes Copilot into a vast enterprise base, and its OpenAI partnership reinforces the whole platform. Meaning, unlike a company whose entire investment case rests on one new product category succeeding, Microsoft's AI bet is layered across several already large, already profitable existing businesses simultaneously. The valuation picture and market scale. Microsoft's market capitalization stands at approximately $3.1 trillion, with one source noting directly that Microsoft is not a cheap stock, despite this diversification. A useful, honest counterpoint to the stable equals safe equals cheap assumption a less careful viewer might draw from the diversification narrative above. The stock recently traded around $372.97, and separate commentary specifically described Microsoft as potentially the most oversold large-cap stock, in the view of at least one prominent analyst, a notably different read from the not cheap framing. Another real, sourced example of the kind of analyst disagreement that is normal and expected for any actively covered, widely held stock. The genuine, sourced risk specific to Microsoft, the single open question independent coverage repeatedly raises is whether AI capex keeps converting into revenue fast enough to justify the spending curve. Directly relevant, given that Microsoft's own electricity demand for AI data centers is projected to surge over 600% by 2030. An enormous, multi-year capital and infrastructure commitment that requires sustained, converting AI revenue growth to justify, rather than a single strong quarter. A second, separate market-wide risk applies directly to Microsoft alongside the other largest U.S. companies. Independently tracked insider trading data shows that, across Nvidia, Apple, Alphabet, Microsoft, and Amazon combined, almost $16.1 billion more in stock has been sold than purchased by insiders over the trailing 2 years, though the same source provides an important, honest caveat. A meaningful share of this is routine, tax-related selling of compensation-based stock grants rather than necessarily a directional signal, and insider selling carries less unambiguous meaning than insider buying does. What Alphabet actually does inside the AI build-out, Alphabet's AI exposure runs through two distinct channels: AI integrated directly into Google Search and YouTube, the company's enormous cash-generative advertising businesses, and Google Cloud, a hyperscale cloud infrastructure provider competing directly with Azure and Amazon Web Services for the same enterprise AI workloads covered in the Microsoft segment. Independent coverage frames the specific investment case directly. Alphabet offers better value than several AI peers because its advertising business continues generating strong cash flow, while AI adoption grows across Google Search, YouTube, and Google Cloud, meaning Alphabet's AI investment is, distinctively among the three names in this video, funded by an already massive, already proven cash engine rather than requiring AI itself to be the primary profit driver from day one. The current numbers sourced directly. Alphabet's share price stood at $343.71 as of late June 2026, with a trailing P/E ratio of 25.96, described directly as in line with the average of its peers, which is 25.55, and specifically 5% below its 10-year historical average of 27.44. This is a meaningfully different valuation profile from Nvidia's contradictory P/E versus PS picture covered earlier in this video. Alphabet's P/E sits close to both its own historical norm and its direct peer average, a comparatively unremarkable, unstretched reading by the standard this channel's other content has emphasized, always checking a ratio against a specific comparison point rather than in isolation. A genuinely notable sourced real-world signal. Independent coverage specifically notes that Berkshire Hathaway has taken a big stake in Alphabet in 2026 as Alphabet's AI investments appear to be paying off. This is a meaningful data point, distinct from analyst price targets or ratio comparisons. A large, real capital allocation decision by one of the most closely followed institutional investors in the world, made with real money rather than a published opinion alone. Though, as with any single data point, it should be weighed as one input among several rather than as a standalone verdict. Why earnings cover both AI investment and cash flow matters specifically for risk comparison among the three names. Among the three companies covered in this video, Alphabet's existing advertising cash flow provides a buffer the other two do not have in quite the same form. Nvidia's investment case depends almost entirely on continued AI hardware demand specifically, and even Microsoft's diversification, while real, is itself increasingly AI-dependent across its newer growth segments. Alphabet's advertising business, by contrast, was already a dominant, highly profitable franchise before the current AI build-out began, meaning a slower-than-expected AI payoff would leave Alphabet with a larger pre-existing profit base to fall back on than a company more singularly dependent on AI-specific demand. The genuine sourced risk specific to Alphabet. The same broad, market-wide caution covered for Microsoft applies directly here as well. Alphabet sits among the handful of trillion-dollar-plus companies whose combined weight is responsible for most of the heavy lifting in the broader market's gains, and independent analysis specifically warns that the stock market entered 2026 at its second priciest valuation over 155 years, according to the Shiller price-to-earnings ratio, with the two prior instances of comparably stretched market-wide valuations, the dot-com bubble and early 2022, each followed by S&P 500 declines of 49% and 25% respectively. This is not a claim that Alphabet specifically will repeat either historical pattern, but it is a genuine, sourced reason for caution about the broader valuation environment. Every one of these three stocks, including Alphabet, is currently trading within. Let's bring all three together. Nvidia, the chip layer underneath nearly everything else in this video, growing revenue at a pace few large companies in history have matched, with a PE and PEG ratio that look genuinely reasonable set against that growth, sitting directly alongside a price-to-sales ratio that says the opposite, and a real sourced 2026 underperformance against its own sector amid emerging competitive and customer concentration pressure. Microsoft, the platform layer, spreading its AI exposure across several already dominant existing businesses rather than betting everything on one new category, genuinely more diversified than Nvidia, but explicitly not a cheap stock as a result, with its own enormous multi-year capital commitment requiring sustained AI revenue conversion to justify. Alphabet, the cloud and advertising layer, trading at a valuation close to both its own history and its peer group, backed by a pre-existing, highly profitable cash engine that gives it a buffer the other two do not have in quite the same form, with a notable real money vote of confidence from one of the world's most closely watched investors. All three trade inside a broader market that, by at least one long-run historical valuation measure, sits at its second most expensive level in over a century and a half. A fact that applies to all three names simultaneously, regardless of which one's individual story you find most compelling. None of these three companies pays a dividend yield large enough to make the Canadian RRSP versus TFSA withholding tax distinction especially meaningful the way it does for the dividend-focused US ETFs covered elsewhere on this channel. For these three specifically, the more relevant Canadian consideration is simply recognizing that holding any combination of them, on top of a diversified core, concentrates your portfolio further into a single sector and a small handful of already massive companies.